period 1970 to 1980, the US dollar lost 75% of its purchasing power. That's what I think happens over the next 10 years. In the 1970s, the gold price ran 30-fold. I'm not suggesting the gold's going to go 30-fold. I'm suggesting that if the performance of gold mirrors the negative performance of the US dollar, that the gold price could run 3-fold or 4-fold. That's what I'm suggesting. If you cut the interest rate too much, what happens is that the attractiveness of US dollar-based savings declines. Money flows out of US dollars into competing currencies or into things like gold. As the interest rate falls and the currency weakens, gold does well.
Veteran investor RickRule is drawing attention to a pattern that bears an uncomfortably familiar resemblance. He sees clear parallels between the current monetary environment and the inflation-driven turmoil of the 1970s, warning that we may be in the early stages of another significant devaluation of the US dollar. His outlook isn't based on theory, it's rooted in historical precedent. Between 1970 and 1980, the dollar lost roughly 75% of its purchasing power. During that same period, gold rocketed from $35 to $850, and silver jumped from under $2 to $50. Despite the volatility, like the sharp correction from 1974 to 1976, precious metals proved to be powerful hedges against the erosion of fiat currency. That decade carved out a playbook for how to survive, and even thrive, during a prolonged currency crisis. Zooming out further, the case becomes even more compelling. Since the creation of the Federal Reserve in 1913, the US dollar has lost more than 96% of its value. The turning point came in 1971, when President Nixon ended the gold standard. That decision unshackled the government's ability to print money without restraint, setting off the very inflationary forces that propelled gold and silver to historic highs. The mechanism behind currency devaluation hasn't changed since then. When central banks expand the money supply without creating equivalent economic value, the purchasing power of each dollar declines. In that environment, gold's finite nature and universal recognition give it a unique edge. It doesn't inflate, it reprices, and that dynamic has held up through every major monetary reset. Rule isn't calling for a repeat of the 1970 blow-off top. He doesn't expect gold to rise 30-fold like it did back then, but he does believe that if the dollar continues to weaken, a more realistic 3- to 4-fold increase is still on the table. That would put gold in the $6,000 to $8,000 range. Less sensational, but potentially just as effective in protecting wealth as it was half a century ago. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
So let's unpack that. I would make the argument that gold is cheap. Gold does well when people are concerned about the maintenance of their purchasing power in fiat currencies, in particular the US dollar. I would suggest that as a consequence of the deficit, that the US dollar repeats its performance of the decade of the 1970s, where it lost 75% of its purchasing power. If that's true, it wouldn't surprise anybody, I think, if that's true, to see the gold price mirror the decline in the US dollar, which is to say go up 3-fold or 4-fold. How far has gold come? Yes, it's come a long way. Remember how far gold ran in the decade of the 70s, the last time the US dollar lost 75% of its purchasing power. In gold bull markets, gold stocks follow gold. Gold has moved, but the gold stocks, with the exception of the biggest and the best, haven't moved very much at all. The biggest and the best have moved, which is indicative of about the first quarter of a gold bull market. The best of the best moves, then the best of the rest moves, then it goes down the quality chain. You're seeing farther down the quality chain. You are seeing the best of the tertiary companies in the space. They haven't moved yet at all. They are, in fact, cheap if we're in a gold bull market. But my argument is that if you took a net present value of them a year ago with the gold price that existed a year ago, the net present value of their free cash flow at $2,200 gold means that their free cash flow valued at $3,300 gold. In fact, if you do price cash flow or price net asset value, they're selling at lower multiples today at a higher price than they were back then. The price, not the price, the margin that they earn at today's gold price is so much higher than the margin that they earned at the gold price that existed then, that despite the fact that the stock is up 100%, by any reasonable valuation metrics, they are cheaper now than they were then. The circumstance that we're in the United States, with $37 trillion in on-balance sheet liabilities, or as Stockman pointed out, $29 trillion net of the Fed's own balance sheet, and $100 trillion off balance sheet liabilities, it would appear to me and to David that the only way that we honor the nominal value of our obligations is to devalue the purchasing power of the dollar. We did that in the decade of the 70s. The Office of Management and Budget, which he was the head of, tells us that in the period 1970 to 1980, the US dollar lost 75% of its purchasing power. That's what I think happens over the next 10 years. In the 1970s, the gold price ran 30-fold. I'm not suggesting the gold's going to go 30-fold. I'm suggesting that if the performance of gold mirrors the negative performance of the US dollar, that the gold price could run 3-fold or 4-fold. That's what I'm suggesting. The interest rate is the compensation that private sector investors receive for tying up their money and for inflation. And this is really the crux of the issue. If you believe the federal government's measure of inflation, the CPI, you're in fairly good shape. You are getting paid 4.5% in the US 10-year Treasury in a currency where your purchasing power is declining by 2.5%, meaning you're making a 2% real yield. I don't happen to believe the CPI. When I look at the basket of goods and services that I consume, Paul, or that you consume, my belief is that the underlying rate of deterioration of the US dollar is more like 7.5% or 8%. If you cut the interest rate too much, what happens is that the attractiveness of US dollar-based savings declines. Money flows out of US dollars into competing currencies or into things like gold. As the interest rate falls and the currency weakens, gold does well. Now, it's interesting that at the same time that Trump is for lowering the interest rate, he has also said that a lower US dollar would not be a bad thing in terms of export competitiveness. We saw this before in the decade of the 80s, where there was successive currency devaluations by various governments. One of the things I like about gold is it is one of the few mediums of exchange in the world that doesn't have a domestic political constituency for devaluation. If we devalue the dollar, our exports become more competitive in Europe and Japan, which gives them an incentive to devalue the euro and the yen, respectively. What's lovely about gold is, as I say, there's no political constituency for devaluation. Among other currencies, on occasion, you have an incentive for a race to the bottom. I'm surprised that there wasn't more of a discussion of interest rates on the macro panel. It would appear that there's intense political pressure on the Fed to lower the interest rates. At the lower levels of the Federal Reserve believes that they're the only institution of the U.S. government that's involved in defending the dollar. They believe that Congress has totally lost the plot, and it's only the maintenance of relatively high interest rates that's defended the dollar. I remember myself very well in the decade of the 70s, when interest rates were allowed to rise some to kill inflationary expectations in 1975. That rise in interest rates was fairly steep, and it really cracked the gold price for 9 months. It also cracked the equity markets, obliterated the debt markets, and hurt the housing markets. When the political forces lost their courage, cut interest rates to re-stimulate the economy, gold was off to the races. Wall Street knew the government is not going to defend the dollar's toast, here comes gold. If they succeed politically in causing the interest rate to fall, the gold market will take a real romp, similar to the romp that it took at the end of 1975 through 1976.
RickRule isn't looking at mining stocks the way most investors do, and that's the point. He argues that Agnico Eagle offers more value today than it did 18 months ago, despite its share price having doubled. The key, he says, isn't where the price was. It's the net present value of the business at today's gold price. And at $3,300 per ounce of gold, Agnico's intrinsic worth far exceeds what it was when gold was trading at $2,200. What sets Agnico apart is its ability to manage cost inflation effectively. While other major miners struggled as rising input costs squeezed margins, Agnico kept a tight lid on its expenses. That discipline matters. Every dollar increase in the gold price drops more cleanly to the bottom line when costs stay flat. It's operational leverage in action, and it's the difference between surviving and thriving in this sector. The backdrop has also improved since 2024. Rule's point is clear. Valuation isn't about where a stock traded in the past. It's about how much value the business generates now and how well it's positioned to benefit from a rising gold environment. On that front, Agnico isn't just keeping up, it's setting the pace. Let's get back to the interview.
In the early 1990s, nobody paid for optionality. It was free. When Rudy Frank built Seabridge, he acquired KSM for $300,000. Nobody paid for optionality. When we built Vista, we could buy ounces in the ground for $1 an ounce. They were worth nothing on a net present value basis, but you got the optionality for free. When Ross Beatty built Lumina, you could buy copper deposits that majors had spent $90 million on. You could buy them for $2 million. Optionality has a price tag associated with it now, so I'm less attracted to it. That doesn't mean that these things won't trade up. What it means is that optionality was a better deal when you got it for free. It's a less good deal now. Now, if you're looking at real gold companies as opposed to the pretenders, let's look at Agnico Eagle, a boring stock. I love boredom. Back of the envelope calculation, if you do a net present value on Agnico Eagle and you use a $3,300 gold price and you model the cash flows out 5 years, 10 years at today's prices and costs, the stock is actually cheaper relative to $3,300 gold than Agnico was at half this price 18 months ago with $2,200 gold. Because if you use 2,200 as the baseline for doing a net present value calculation, the net present value number that you get is materially lower than you get if you use 3,350 as a baseline. For real gold companies, the leverage to the gold price, which you enjoy next year, next month, is much higher than the real optionality you get on gold price on the gold price for deposits that may never go into production. Or if they do, will go into production at a gold price scenario, which could be materially higher or lower than today. What will change is the stupidity of investment markets and the willingness of speculators to overpay. A deposit with the average grade of seawater that has some gold and has fairly high upfront capital costs will come to be valued in the market on an in situ value per ounce metric, which from an investment point of view is entirely irrelevant, but will matter to speculators. There was a time in my youth when I thought I was smart enough that I could trade against the expected stupidity of my counterparties. I don't do that anymore. I do absolute valuation. I'm uninterested in monetizing fiction. In the exploration companies, you are modeling the probability that what will become the net present value of the asset 5 years from now is materially higher than the enterprise value today. That's a process of anticipating and measuring the probabilities of the answering of unanswered questions over time. If the company's target, you think 5 years from now, will have a net present value of $1 billion, and the market capitalization of the explorer today is $50 million, you need to decide what is the process by which the market gets certain of that $1 billion valuation, and what is the probability of the successful completion of every unanswered question in the process between here and there. It might be that for an exploration stage company, that they have a large mineralized anomaly in northwestern BC. They've done surface sampling, grab sampling, by nature selective, and they've outlined a large mineralized anomaly. The first question might be, is that transported gold, or is it in situ? And to answer that question, they might need to do a trenching program to see that the gold extends through soils into bedrock. And it might be that they need to do an extensive trenching program. That would be the first unanswered question. In other words, is this mineralized anomaly ubiquitously mineralized, and is it mineralized at depth? And you would try to gauge, A, from the experience of the people asking the questions, B, from the nature of the surface sampling program they did, what's the probability that the trenching program will give them a drillable anomaly? And it might be that you decide that it's highly likely that this will occur. Highly likely. And so you will speculate on a yes answer. Let's assume you get a yes answer now. You have refined your knowledge of this thing from selective grab samples to systematic trenching, and you have a legitimate mineralized anomaly. Now you need to test the third dimension. You need to say, does this extend to depth? And what does the grade profile look like at depth? So it might be that you propose to test this with a 10-hole drilling program. Again, you as a speculator need to look at what a yes answer is worth. In other words, if they have a reasonably successful 10-hole drilling program and they define a resource, which hasn't been measured or indicated, but they've defined a resource, what is the market likely to pay for that? And what is the probability of success likely to be? So let's say, just for fun, that you have a 10-hole program, which turns out to be a success. Then the next thing might be, okay, so now we need to drill it off systematically. We need to test depth extension, strike extension, width extension, and depth. In other words, we need to develop a target size. we need to begin to move into the PEA status. And that might be a 50-hole program. Again, you try to determine what the yes answer is worth and what the probability of achieving that yes answer is. Mercifully for me, most of my competitors are unwilling to do all that. Most of my competitors pursue a strategy called got a hunch, bet a bunch.
Step back from the daily noise, and a larger pattern comes into focus. What we're seeing isn't just another bullish case for gold, it's a broader unraveling of trust in fiat money itself. Decades of unchecked monetary expansion have eroded the foundation of the dollar, and history keeps reminding us how that story ends. Meanwhile, well-positioned miners are quietly capitalizing on this shift, proving that actual value lies not in price swings, but in how businesses adapt and scale when the rules of the game change. The real winners won't just ride the gold wave, they'll be the ones built to last when the tide goes out. If gold isn't inflating but simply adjusting to reality, what does that say about the reality most investors are still pricing in? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.